When you first start trading, the market is pure chaos. You're hit with a barrage of moving shapes, jagged lines, and abstract data points, and it feels completely impossible to find a clear signal in the noise. So, naturally, you try to memorize the dictionary. You learn to spot a textbook engulfing bar or a perfect pint bar, assuming that recognizing these isolated geometric patterns will give you an edge. But then you follow the rules to the letter, place your trade, and still watch your money disappear. Analyzing individual bars without an overarching market anchor makes even the most perfect candlestick patterns useless. Without the why behind the move, you are simply trading your perception of price rather than the reality of the market. The market operates as a continuous narrative, constantly building on what happened hours or days before. If you ignore that context and focus entirely on microscopic movements right in front of you, you're essentially skipping to the last page of a novel and wondering why the ending makes zero sense. To pull consistent profits from the market, you have to replace emotional guesswork with a rigid framework that filters that noise down to a single decision. This requires exactly 3 checkpoints: direction, location, and execution. By strictly following these 3 steps in order, you strip away human perception. Trading stops being an exercise in gut feeling and transforms into a completely systematic, mechanical routine. On a high time frame, like the 4-hour view, your job is to figure out who is in control. By looking at these peaks and valleys, we can see buyers are dominating, establishing a firm upward trend. Once you know the buyers are in charge, you define your swing range by marking the most recent high and the most recent low. Everything outside of this exact range is a distraction. You tune out the noise and commit your focus strictly to this active channel. Now that you have your direction, you shift down to the 1-hour time frame to figure out exactly where to enter the market. You know you want to buy, but buying in the middle of a random price spike lowers your odds of success. To find the optimal entry point, we divide this chart segment straight down the middle. The top half is the premium zone, where the asset is expensive and overbought. The bottom half is the discount zone, where the asset is cheap and right for buyers to step back in. If you are looking to buy, you absolutely must wait for the price to fall completely into that discount zone. You're waiting for an extreme demand zone near the very bottom, the absolute last line of defense the buyers have before the entire structure collapses. Restricting entries to these deep discount locations is the only mechanical way to maximize upside potential while keeping downside exposure as tiny as possible. With the direction and location locked in, you zoom down one last time to the 15-minute time frame. This is where you determine the precise mathematical moment to execute the trade. Cautionary tone. A common mistake is blindly pulling the trigger the exact second the price taps your optimal location. But an asset can easily crash right through that floor, wiping out your capital instantly. You still need proof the buyers are showing up. This chart isolates the micro-confluences we need. First, we look for a strong rejection candle. We watch the selling pressure drive the price down until a sudden injection of buying power swallows the previous bar, signaling a high probability shift in control. Next, that upward surge needs to break through the previous high and close above it. This confirms that the short-term structure is now aligning perfectly with our macro 4-hour bias. Finally, we need a failure to continue. When the sellers attempt to push the price back down a few minutes later, there simply isn't enough supply in the market to drive it lower. The pullback stalls out, and the price starts climbing again. Your capital is only put at risk when these highly specific micro triggers stack together, perfectly nested inside your wider macro boundaries. These nested parameters dictate the exact boundaries of your financial risk before a trade even begins. On this chart, we lock in our risk. We place a stop loss tucked strictly under that rejection candle. If the price falls past that line, the bullish structure breaks. Our thesis is instantly proven wrong, and the trade is killed automatically for a minimal loss. Then, we set our target exactly 3 times the distance of that stop loss. By enforcing a rigid 3-to-1 reward ratio, you can lose multiple trades in a row, and a single win will still pull your account back into profit. Knowing the exact price point where your analysis fails is far more valuable than blindly guessing when you'll be right.
But the true test of this system happens when the conditions don't perfectly align. That is when you physically lift your hands off the keyboard, rest them on the desk, and surrender to absolute stillness. If the price drifts in the middle of a channel, If a single micro-trigger is missing, or if the data simply contradicts itself, you do nothing. Amateurs impose their personal desires onto the market, forcing a trade because a setup looks vaguely familiar or because they are desperate for action. Professionals execute strictly on objective, unemotional price action. When you master this macro to micro funnel, you strip the frantic anxiety out of your daily routine. You stop trying to predict the future and focus entirely on a brutally boring, highly systematic process for extracting resources.